All right, welcome back to the deep dive. So today we're diving into something that's been on a lot of our listeners' minds.
Absolutely.
It's this idea of like, okay, AI is changing everything, right? Every industry, every aspect of life, and people are wondering what that means for their investments, their savings. In this new world of super intelligent machines and algorithms, what happens to the old faithfuls, the things that have traditionally been seen as safe havens, like, good old gold and silver?
Right, right. Like, do these precious metals still have that same kind of magic, that same kind of appeal in this new landscape?
Exactly, exactly. And, you've sent us a ton of stuff, articles, research papers, even some like handwritten notes, really digging deep here.
Yeah, the listeners are definitely engaged for this one.
Oh, yeah, for sure. And we're going to try to do it justice today. So, what we really want to get into is like, why? Why would these metals that have been around, literally for millennia, why would they still be considered important havens, in this age of rapid technological advancement?
Yeah, it's a question that deserves a proper deep dive.
Absolutely. So, first things first, let's get on the same page about what we even mean when we say safe haven investment. From all this material you've sent, it seems like the basic idea is an asset that's, expected to hold its value, maybe even increase in value when things get a little shaky, when the economy's having a bad day, when the stock market takes a tumble like a shelter during an economic storm.
Yeah, exactly. And a crucial part of that safe haven status is that it doesn't move in the same direction as the rest of the market.
Oh, right, right. So it's like if everything else is going down, down, down,
Yeah,
you want something in your portfolio that's maybe going up or at least not crashing as hard.
exactly, exactly. So, think of it like when stocks are zigging. You want something that's zagging. It's about smoothing out those bumps in your portfolio.
It's about not putting all your eggs in one basket.
Precisely. And the goal with safe havens, it's not necessarily about getting those like huge massive returns. It's about preserving what you've got. It's about limiting those losses during times of uncertainty.
Okay, makes sense. So, what are we actually looking for when we try to identify a safe haven? What makes something a safe haven?
Right. So your research has highlighted several key characteristics.
Okay, lay 'em on me.
Okay, so first, you got to think about liquidity. How easily can you buy or sell it? Because, in a crisis, you might need to get in or out of a position quickly.
Right, right. You don't want something that's like stuck.
Exactly. Then there's functionality. Does it have a practical use? Is there a real demand for it, beyond just its investment value?
Okay, so it's got to be useful for something.
Right. And maybe most importantly, limited supply. You can't just create more out of thin air. That's key to preventing devaluation,
Hmm.
especially when you compare to currencies that governments can just print more of, leading to
All
inflation.
right, so scarcity is key here.
Absolutely. And, we're also looking for certainty of demand. Is this something people will continue to need and want in the future?
Right, so it's not just a fad.
Exactly.
Oh.
And then there's permanence. It shouldn't degrade or become obsolete. These are all kind of the foundational principles of a long-term store of value.
Gotcha. So it's got to be something that lasts, that holds its value over time.
Precisely.
So in addition to those, we've also got price stability, right? We don't want something that's fluctuating wildly all the time.
Right. That's important. You want it to be relatively stable.
Yeah. And it should ideally act as a hedge against inflation, meaning it helps to protect your purchasing power as prices rise.
Exactly. Exactly.
Then, of course, we need to see a proven track record. Has it actually performed well during past crises? Does it have that historical precedence?
Yeah, history is a good indicator of how an asset might behave in the future.
And it should have global recognition and acceptance. It's got to be something that's trusted across different economies and cultures.
Absolutely. You want it to be universally recognized as a store of value.
And finally, limited economic dependence. Its value shouldn't be too closely tied to the performance of any single economy or sector.
Yeah, you don't want it to be overly reliant on one particular country or industry doing well.
Right. It's about diversification, spreading the risks.
Exactly. So taking all these traits together, you start to build a picture of an asset that can provide a sense of reliability when things get unpredictable. It's less about trying to make a quick buck and more about protecting your wealth for the long haul.
Okay, so classic examples from the research you've sent, gold, silver, right. Those are the obvious ones. But then you also have things like government bonds from stable countries, strong currencies like the US dollar, the Swiss franc, or the Japanese yen, and even, some types of stocks like companies that provide essential goods and services, things that people will always need regardless of what's happening in the economy. Think like utilities, healthcare, that kind of thing.
Right. Those are called defensive stocks.
Okay, so that gives us a good framework. Now, let's get into the nitty-gritty of how gold and silver have actually performed during past economic crises. Let's start with gold. And the data you shared is pretty compelling.
Yeah, it's really interesting to see how gold tends to kind of zig when the rest of the market zags.
Yeah, it seems to like almost act as a counterbalance.
Exactly.
Mm.
Look at the 1973-75 recession, for example. Your research shows that gold prices, they actually jumped by a massive 87% during that time.
87%. That's a huge increase.
It is. And then fast forward to the 2008 global financial crisis, when the stock market was in free fall. Gold, on the other hand, it actually surged by around 25% in that year alone.
So while everyone else was panicking, gold was like chilling.
Pretty much. And even after an initial dip, when things first started to get really bad, it bounced back strongly. And by the end of the year, it was still up. And over that whole 18-month period when the stock market was declining, gold actually gained over 25%.
It really does live up to that reputation as economic disaster insurance. I've seen it called that before.
Yeah, and it's not just those two examples. More recently, during the initial uncertainty of the COVID-19 pandemic between January and August of 2020, gold prices increased by a significant 28%. So you see that pattern again and again. When traditional assets like stocks are struggling, gold tends to provide a degree of stability, a safe haven.
It's like the worse things get, the better gold seems to do.
In a sense, yeah.
And some analysts are even predicting, this is from your research, that gold could potentially reach over $3,000 an ounce as fears of a recession continue to grow. I mean, the historical evidence is certainly there. Now, what about silver? From what I've seen, it seems like its performance has been a bit more, well, mixed.
Yeah, that's true. And that's because silver is a bit more complex than gold. It's not just a precious metal. It also has significant industrial applications.
Oh, right. So it's used in manufacturing and technology and all sorts of things.
Exactly. So while gold's price is primarily driven by its, safe haven appeal, its monetary value, silver's price is also influenced by the demand for those industries.
So it's got kind of a dual personality.
Yeah, you could say that. So when we look at past crises, you see that reflected in its performance. For instance, during the 1973 recession, silver prices actually rose by over 40%. Pretty impressive, right?
Yeah, definitely.
But then, if you look at the 2008 financial crisis, while gold was rallying, silver actually declined by about 8%. So you see how that industrial demand can sometimes pull it in a different direction.
It's more sensitive to those broader economic ups and downs.
Exactly. However, and this is a key point, even though it can decline during crises, silver often doesn't fall as sharply as the overall stock market. So there's still that element of resilience.
Okay, so it might not always be a mirror image of gold, but it's still holding up relatively well.
Right. And historically, it's actually outperformed the S&P 500, which is kind of the benchmark for the U.S. stock market, in 3 of the last 8 recessions. And there's also this interesting point from your research that silver can potentially perform even better as a safe haven if it's already in a bull market, meaning its price is already trending upwards before a crash hits.
That makes sense. It's like it's already got momentum.
Exactly.
Okay, so let's shift gears a bit and talk about inflation. I mean, we've seen a lot of it lately, and historically, both gold and silver have been seen as ways to protect yourself from the erosion of purchasing power. Right?
Yeah, kind of.
And the classic example, of course, is the 1970s in the U.S. when inflation was just through the roof. Gold prices, I mean, they skyrocketed from $35 an ounce in 1971 to over $850 an ounce by 1980.
Yeah, that was a period of really high inflation. And, one of the key reasons gold performs so well is that it has a limited supply. Unlike fiat currencies, paper money, which governments could just print more of, you can't just create more gold out of thin air. So as the dollar weakens due to inflation, gold tends to become more attractive as a store of value. And while the short-term effectiveness of gold as an inflation hedge can be debated, its long-term track record as a store of value is very strong.
So it's about scarcity and that inherent value, right?
Exactly.
And silver also seems to have played a role in this. Your research suggests that it's been a particularly effective hedge against inflation since the year 2000, even outperforming the rate of inflation. And the significant increase in its inflation-adjusted returns between 2008 and 2011 is another key piece of data you shared.
Right. So both metals Because of their limited supply and intrinsic value, they can offer some protection against that erosion of purchasing power that comes with inflation.
Okay. So we've talked about economic instability, we've talked about inflation. Now let's throw another wrench into the mix, geopolitical uncertainty. And it feels like we've got plenty of that to go around these days. How do gold and silver typically react to these kinds of events, when things are tense on the global stage?
Yeah, so geopolitical tensions, whether it's conflicts, trade disputes, political instability, those tend to inject a lot of uncertainty into the global financial markets.
Yeah, people get nervous. They don't know what's going to happen next.
Exactly.
Yeah.
And historically, that uncertainty has often led investors to seek out safe havens like gold and silver. There's that flight to safety, as it's often called. People get scared. They want to protect their assets. And gold and silver, with their long history and stability, they tend to benefit from that.
Makes sense. And we've seen this play out in the real world, haven't we? Like when tensions escalate in the Middle East, for example, gold prices often spike.
Absolutely. And it's not just individual investors who are reacting this way. Central banks, the institutions that manage a country's currency reserves, they also tend to increase their gold holdings during periods of heightened geopolitical risk. That further supports the demand and pushes prices up.
So it's like a self-fulfilling prophecy almost. The more people worry, the more they buy gold and the higher the price goes.
Yeah, there's definitely that feedback loop. And while gold tends to be the primary beneficiary of this flight to safety, silver also sees increased demand. That might dip initially when things first get shaky, but then it often rebounds as investors look for a more affordable alternative to gold.
Okay, so it's not just about gold. Silver's got its own role to play in this geopolitical chess game.
Absolutely.
So we've established that gold and silver have a strong track record as safe havens. Now let's dig a little deeper into some of the fundamental, long-standing reasons why they've held this appeal for so long. And the first thing that jumps out from all this research is their limited supply.
Yeah, that's a big one. Unlike currencies, which governments can just print more of, the total amount of gold and silver on Earth is finite. You simply can't just create more.
Okay, they're not making any more of it.
And, your research highlights that global gold production actually peaked some time ago, and the annual increase from mining is relatively small compared to the total amount that's already out there.
So it's a slowly shrinking pie.
Yeah, in a way. And while recycling does add some to the supply, it doesn't fundamentally change the overall scarcity. And it's not just gold. Silver is also facing potential supply deficits, especially with the growing demand from the green technology sector.
Oh, right. I mean, silver is used in solar panels, electric vehicles, all that stuff.
Exactly. So that inherent scarcity, it's one of the key underpinnings of their value. It makes them less vulnerable to inflationary pressures because you can't just print more of them.
So scarcity equals value.
In a nutshell, yeah.
Another big reason for their enduring appeal is their intrinsic value. It's not just about, speculation or trading.
Yeah.
They have an inherent worth that goes beyond what the market happens to be valuing them at on any given day.
Exactly. Gold has been a recognized store of value for thousands of years across countless cultures. It's not just sitting in vaults. It's used in jewelry, electronics, and other industries. Silver, with its dual role, has even wider applications. And then there's that psychological aspect, the fact that they're tangible. You can hold them in your hand. You can feel their weight. In a world that's increasingly digital, there's something reassuring about that.
It's that sense of, realness, right? Like, you can't just hack it or lose it in a digital glitch.
Exactly. And the third traditional reason that's highlighted in your research is their lack of strong correlation with traditional assets, like stocks and bonds.
So they don't move in the same direction.
Right. And that's a huge advantage because it provides diversification for your portfolio. When stock and bond markets decline, gold and silver often hold their value, maybe even increase in value. And while silver's correlation can be a bit more variable because of its industrial uses, gold has consistently shown itself to be a great diversifier. Very low correlation with other major asset classes.
So it's like having a backup plan, a safety net.
Exactly.
Okay, so we've got a good understanding of why gold and silver have historically been seen as safe havens. Now, let's bring in the elephant in the room, artificial intelligence. How might the rise of AI potentially shake things up, change the financial landscape? And what could that mean for gold and silver?
Yeah, that's the million-dollar question, isn't it?
Let's start with AI's potential impact on productivity.
Right. Your sources paint a pretty clear picture. AI is going to be transformative. It has the potential to significantly boost productivity across the board. Some estimates suggest trillions of dollars could be added to global GDP by 2030 through things like automation, enhanced data analysis, improved decision-making.
So it's all about efficiency, right? AI doing things faster and better than humans can.
Yeah, think about AI augmenting human workforces, automating routine tasks, leading to the development of new products and services. The initial impact might be a bit slow as businesses adapt and implement these technologies, but the long-term potential for increased productivity seems pretty undeniable.
So more stuff, more quickly, more efficiently. But could that potentially lead investors to shift away from safe havens? I mean, if the economy is booming because of AI, maybe people are less worried about needing a safety net.
That's certainly a possibility. In an environment of strong, sustained economic growth, investors might be more inclined to chase higher returns in, growth-oriented sectors.
So it's like, why play it safe when you can ride the wave?
Yeah, something like that. But we also have to consider the potential downsides, the new uncertainties that AI could introduce.
Right, because not everything about AI is like sunshine and roses.
Exactly, and that brings us to the impact of AI on employment. This is a big one, and it's a bit controversial. He's got predictions of massive job displacement on the one hand and the creation of entirely new jobs on the other.
So it's kind of a mixed bag.
Yeah, it's a complex issue. AI is going to automate a lot of existing tasks, so there will definitely be job losses in certain sectors. But it's also projected to create millions of new jobs in fields related to AI itself, like development, implementation, maintenance, that kind of thing.
So some jobs lost, some jobs gained.
Right. But the overall net effect on employment is still up for debate. Some experts think there'll be a net gain in jobs. Others foresee significant displacement, meaning lots of people will need to be retrained, reskilled. And that kind of disruption in the job market could actually create economic uncertainty and anxiety.
So even if the overall economy is doing well, there could be pockets of instability and fear.
Exactly. And those who are worried about their jobs, they might actually be more likely to turn to safe havens like gold and silver as a way to protect their savings. And there's also the potential for AI to exacerbate existing income inequalities. If the benefits of AI are not distributed evenly, you could see a widening gap between the haves and have-nots.
So more instability, more uncertainty, more reason to seek out safe havens.
Potentially, yeah.
Yeah. Okay, what about the impact of AI directly on the financial markets? I mean, AI is already being used in trading and risk management, right?
Yeah, absolutely. It's already a big part of the financial system, and it's only going to become more so. AI-powered algorithms are already executing trades at incredibly high speeds, contributing to market liquidity. But that also introduces new risks.
Like what?
Well, you could see increased market volatility, with prices swinging up and down more dramatically. There's the potential for those flash crashes we've seen in the past, where algorithms trigger a rapid sell-off. And then there's the potential for new forms of market manipulation, using AI to exploit loopholes or create artificial price movements.
So it's like AI can make the markets more efficient, but it can also make them more unpredictable, more dangerous.
Yeah, it's a double-edged sword. And there are also concerns about systemic risks, risks to the whole financial system. If a lot of financial institutions are all using similar AI models, making similar trading decisions based on the same data, you could see a kind of herding behavior.
So if one AI panics, they all panic.
Exactly. And that could lead to much bigger market swings, amplify those ups and downs.
Mm-hmm.
It could also make traditional diversification strategies less effective, because if everything is moving in the same direction, it doesn't matter how much you spread your investments around.
Right, so your safety net might not be as safe as you thought.
And then there's the cybersecurity aspect. While AI can certainly be used to improve cybersecurity in some areas, it also opens up new avenues for attack. Hackers can use AI to develop more sophisticated malware, to target vulnerabilities, to launch more effective attacks.
So it's a constant arms race.
Yeah, pretty much. And all of this, the increased volatility, the potential for new risks, the cybersecurity concerns, all of that could actually make the relative stability of safe havens like gold and silver even more appealing to investors.
So in a way, AI might actually be pushing people towards these traditional assets, not away from them.
That's certainly a possibility, yeah.
Okay, so beyond those specific impacts on productivity, employment, and financial markets, are there broader forms of economic and geopolitical uncertainty that AI might be creating, like big picture stuff?
Yeah, definitely. On the economic front, That potential for widespread job displacement we talked about, it raises concerns about future income levels, about overall economic stability.
Yeah, if people aren't working, they're not spending money, and that can have a ripple effect throughout the economy.
Exactly. And there's also the potential for AI to increase income inequality. If the benefits of AI are concentrated among a small group of people, you could see the gap between the rich and the poor widen even further.
So more economic instability, more inequality, more reason to seek out safe havens.
Potentially, yeah. And then on the geopolitical front, AI is rapidly becoming a major area of competition between nations.
Yeah, it's like the new space race.
Exactly. Countries like the US and China are pouring billions of dollars into AI research and development, and they're both vying for dominance in this field. It has huge implications for national security, for economic power, for the global balance of power.
So more tension, more competition, more uncertainty.
Absolutely. And there are concerns about the potential misuse of AI, about the risks of deploying these technologies without proper safeguards. There's a lot of debate about how to regulate AI, about how to prevent it from being used for harmful purposes. And then you have the involvement of the global south, with countries like India and Brazil also emerging as major players in AI. That adds another layer of complexity to the geopolitical landscape.
So it's a very dynamic, very unpredictable situation. And all of this heightened geopolitical competition, this potential for technological conflict, it creates a climate of uncertainty that could drive demand for safe havens like gold and silver.
Definitely. And, let's not forget about this other big trend that's happening right now, the increasing reliance on technology and digital assets in our lives and in the financial world. How does that play into the attractiveness of physical gold and silver?
Yeah, good point. I mean, everything's moving online, everything's digital, even our money.
Exactly. And while there are benefits to that, convenience, efficiency, there are also vulnerabilities. Think about cryptocurrencies, for example. They offer certain advantages, but they're also inherently reliant on complex technological infrastructure.
Right. So if the internet goes down or there's a major cyber attack, what happens to your crypto?
Exactly. Physical gold and silver, on the other hand, they don't have that problem. They're tangible. They exist outside of the digital realm.
So it's like a backup plan for the digital age.
Yeah, in a way. They can act as a hedge against potential systemic failures in the digital world. You can hold them, you can store them securely, and you have direct control over them. There's no counterparty risk, no reliance on a third party to honor your claim, and they have that long history as universally recognized stores of value, which provides a level of trust and stability that newer digital assets are still working to establish.
So in a world that's becoming increasingly digital, the physicality of gold and silver might actually become even more appealing.
Absolutely.
But your research does acknowledge that there are some potential drawbacks to holding physical assets.
Yeah, of course. Storing physical gold and silver securely can be expensive. You might need a safe deposit box. You might need insurance. And unlike some other investments, they don't generate any yield. You're relying solely on price appreciation for any potential returns.
So it's not a perfect solution.
No investment is.
Okay, so let's get to the expert opinions. What are the analysts saying about the future of gold and silver in this AI-driven world?
Well, the overall outlook seems to be pretty positive. Your research mentions forecasts for gold prices in 2025 potentially reaching around $3,000 an ounce, with some even suggesting peaks of $3,200 to $3,300.
Wow, that's a significant increase.
Yeah, and the reasons behind this bullish sentiment are pretty clear. You've got ongoing geopolitical tensions, concerns about trade wars, persistent inflation, strong demand from central banks, and healthy investor inflows into gold ETFs.
So all those factors we've been talking about are kind of feeding into this positive outlook.
Exactly. And silver is also looking pretty good, with some analysts predicting prices could reach around $40 an ounce by 2025. That's driven by strong industrial demand, especially from the green technology sector, ongoing supply constraints, and renewed interest in silver as a more affordable safe haven compared to gold.
Okay, so both metals are expected to do well. But what's the reasoning behind that? I mean, why are experts so confident in gold and silver, especially given all the potential disruptions that AI might bring?
Well, they believe that gold, in particular, will continue to be a reliable safe haven because of its historical stability, its track record of protecting against inflation and economic uncertainty, and its role as a portfolio diversifier. Silver is also expected to benefit from its safe haven appeal, but its industrial importance could give it even greater upside potential. And there's even some suggestion that AI itself could be used to improve gold price forecasting and help central banks manage their gold reserves more effectively. So the general consensus is that both metals will remain important parts of diversified investment portfolios as the financial landscape continues to evolve under the influence of AI.
It's interesting how this cutting-edge technology might actually end up reinforcing the value of these very traditional assets.
Yeah, it's kind of a paradox.
Now, let's do a quick comparative analysis. How do gold and silver stack up against other major asset classes in this AI-driven era? Let's start with stocks.
Right. When you compare gold and silver to stocks, it really comes down to a trade-off between growth potential and stability. AI is likely to drive significant growth in many sectors, so stocks could see big returns. But that growth also comes with increased volatility and uncertainty. Gold and silver can act as a counterbalance, providing stability and capital preservation during those turbulent times.
So stocks are the high-risk, high-reward option, while gold and silver are more about stability and preservation.
Yeah, that's a good way to put it. And while AI might enhance stock picking and market analysis, the risks associated with algorithm-driven trading and unforeseen disruptions could make the relative stability of precious metals more attractive to some investors.
Okay, what about bonds? Traditionally, they've been seen as a safe haven too, right?
Yeah, especially government bonds from stable economies.
Yeah.
But in a scenario of sustained economic growth, which AI could potentially fuel, interest rates are likely to rise. And rising interest rates are bad news for bondholders.
Why is that?
Well, when interest rates go up, the value of existing bonds goes down. It's kind of a seesaw effect. And gold and silver, they don't have that problem. They can act as a hedge against both economic uncertainty and potential currency devaluation, which can also happen when interest rates rise. And unlike bonds, they don't carry the risk of default.
Okay, so gold and silver might be a better bet in a rising interest rate environment.
Potentially, yeah.
What about real estate?
Real estate is an interesting one. AI will definitely impact that sector too, making things more efficient. But real estate is less liquid than gold and silver. It's harder to buy and sell quickly, and it's not as easily divisible. And the rise of remote work, which AI could accelerate, might have a negative impact on the commercial real estate market.
So less flexibility, more uncertainty.
Yeah, compared to gold and silver, which offer greater liquidity and ease of transaction.
Okay, and lastly, how do they compare to other commodities, like oil or copper?
Well, gold and silver are unique in that they're monetary metals. They have a history as forms of currency, as stores of value that goes back thousands of years. Other commodities, their value is primarily tied to their industrial uses. And while silver does have significant industrial applications, gold's primary role is as a financial asset, a hedge against uncertainty. So while the growth of AI might drive demand for certain industrial commodities, gold's safe haven properties are more independent of those cycles.
Okay, so it's kind of apples and oranges.
Yeah, in a way.
So just to quickly recap the potential risks and rewards of holding gold and silver in this age of AI.
On the reward side, you've got their potential to hedge against inflation, to protect your portfolio during recessions, to provide a safe haven during uncertain times, and to preserve your wealth over the long term.
Yeah.
But there are risks too, of course. Prices can be volatile, storing physical assets can be expensive, they don't generate any yield, and their value can be affected by global economic conditions, interest rates, currency fluctuations, all sorts of things.
So it's not a guaranteed win, but it's a potential hedge against a lot of potential risks.
Exactly. And that comparative analysis table you shared really lays it all out nicely, highlighting the trade-offs between different asset classes. It really comes down to understanding your own risk tolerance and your investment goals.
Absolutely. All right, as we wrap up this deep dive, what are the key takeaways for our listeners?
I think the main message is that even though AI is going to be transformative, it doesn't necessarily invalidate the traditional reasons for holding gold and silver. In fact, the new uncertainties that AI creates might actually make those reasons even more relevant.
So the old ways might still have a place in this new world.
Absolutely. And while other assets might offer the potential for higher growth, gold and silver provide that crucial element of diversification and risk mitigation. They're not about getting rich quick. They're about preserving your wealth, about having a safety net when things get rough.
So a balanced approach, as always.
Exactly.
All right, here's a final thought for our listeners to chew on. How might AI itself, with its ability to analyze vast amounts of data and identify complex patterns, how might it change our understanding of safe havens? Could AI actually be used to create new, more sophisticated forms of financial protection? Or could it, on the other hand, undermine the traditional role of assets like gold and silver by making the markets even more unpredictable and uncontrollable? It's something to think about as we continue to navigate this rapidly evolving landscape.
A lot to ponder, for sure.
Thanks for joining us for this deep dive. We'll catch you next time.